Hey, welcome back. After a bunch of demand issues, cost savings and now potential issues from tariffs, Pepsi is falling to even December 2020 prices, so let's have a look into them. We see a bit more than half of the revenue coming from the US, and something that you may not expect if you didn't look into them, a majority of the revenue comes from food, not beverages. They are a giant not only in soda but also food and snacks. Other than Pepsi, they have brands like Mountain Dew, Gatorade, Lay's, Doritos, Cheetos, Quaker Oats and other convenience foods, drinks and snacks. They are also expanding and recently bought Poppi, which is an interesting prebiotic soda company, plus stakes in companies like Clesius, which I actually own. The cash flow dropped by about 7% last year to around 7.5 billion, placing them at a ratio of around 27. But again, we have demand issues due to the environment, so we can't really expect them to grow now. This is a very slow compounder. Since a bit more than half of the revenue comes from the US, where everyone reported issues in consumer demand, I think it's a matter of waiting for the economy to improve. However, the price to cash flow ratio is twice as high as it was a decade ago, so despite the company and the consumer having issues, the market is not giving up on it. I think this can be a bit risky because maybe their defensiveness attracted a higher valuation during uncertainty, which could eventually change. You had a decade of not only stagnating but even dropping until a few years ago, while the stock basically doubled, so is it justified? Financially, we see an okay, not the best position, with the current assets below the current liabilities and quite a bit of debt. The equity is very small compared to the market cap, but keep in mind that Pepsi and Frito-Lay aren't on the balance sheet. They got them through merging back in 1965, so these brands can't appear on the balance sheet. We see goodwill and other intangibles, but that's for other brands that they bought in time. How much are these two worth? It's impossible to know and it depends on the buyer, but I see estimates placing Pepsi at like 20 billion and Lay's at 12. But if you think about how much these two can make, meaning a majority of what the company makes, it's probably well over 100 billion. But keep in mind that the debt is also pretty much at an all-time high now, which is not great when the company pays basically everything as a dividend. They increased their dividend for 52 consecutive years so far, with a 7% increase a few months ago. With the stock falling, the yield is actually getting pretty attractive, but keep in mind that especially with the buybacks, that's more than a 100% payout on the cash flow. I think it's more about the environment being quite bad since the pandemic, and when we see a recovery in demand, this can continue to grow. However, with the payout being so high and them having to increase it unless they want the stock to crash, this can be quite a risky position to be in. When you pay pretty much everything, you can't really increase the dividend by more than what you grow. They have the advantage of being able to use the stock to develop, and I think they should take full advantage of it because right now they seem to be at the mercy of the demand and the economy. Buy something like Conagra Brands, Celsius or whatever and have more growth engines that can fuel the dividend increases. But this is more about the stock. From a business point of view, they should continue to be a very nice defensive compounder even with the high competition, as long as they are smart and invest where they should. But there is also risk of mismanagement, so nothing is guaranteed. Now, despite the new global tariffs, we see that the market barely moved Pepsi. I think that's kind of correct because the company is massive and has supply chains pretty much everywhere. Unlike Nike, who produces in China, Vietnam and so on and then sells in the US, you don't really have this kind of issue with Pepsi. Nike crashed like 10% when the tariffs were announced, by the way. Not only that, but they also have real food, which is a very defensive industry, although the soda, if things become dire, shouldn't be that defensive. However, we've seen countries like France, for example, boycott American brands like Coca-Cola in response to the Trump administration's policies. Tesla is an extreme example even locally, and I don't think this would happen to Pepsi, but any issue would matter in this kind of environment. Cutting that dividend, which eventually has to happen if they decrease or don't recover in time, is probably the worst thing that can happen to the stock, and a few million here and there can make that difference. But if they absolutely need it, they can sell one of their many smaller brands and probably be fine. I don't think they are that close to cutting it. And again, since they depend so much on the US, I think this is all about a recovery in the country's demand. Even rate cuts could free up some of the disposable budget and would probably bring them back to slow and steady growth. Not to mention that it would generally be good for dividend stocks. But there are some issues that could affect their demand that could potentially come from politics. Sugar drinks are a topic in politics and they even got some extra taxes in some countries. But they are adapting because it could potentially get to a point where a normal Pepsi would cost the same as a premium drink in some countries, so why choose it? Again, they bought some premium soda a few months ago, the stake in Clesius, which is a better for you energy drink, and other different/premium drinks and foods. And if anything, this company can issue stock to buy pretty much whatever they want, it's all about the management. And from the looks of it, this is a very merger and acquisition hyperactive management, so that's a plus. Now let's see a valuation. In a bad scenario where the demand issues continue, politics affect them and so on, let's say they get to 5 billion per year and have to cut the dividend. Say the ratio drops to 15 to show the market's reaction to a fallen dividend king, and that's a 75 billion market cap. 15 is generally high for a bad scenario, but it's Pepsi and their brands should probably be worth at least 75 billion, so there is kind of a bottom to how much it can fall. That's a price of 54.69, so among the lowest in like 2 decades. I know it's a massive drop, but keep in mind that this is just them getting back to the ratio from a decade ago. I think this is more than justified if they cut the dividend, we've seen much worse reactions before. On the bright side, from that level, they could potentially pay a sustainable 5% yield without issues, so that could be attractive. And again, I think this is justified because, as I said, the ratio basically doubled and the cash flow pretty much stagnated. All they did throughout this decade was, from the looks of it, enough to maintain it. In a second scenario where they continue to stagnate at 7 billion due to the environment and especially the consumer, let's say the market is trading them at a ratio of 20. Again, this is also a generally high ratio. That's a market cap of 140 billion, meaning a price of 102.11, so around a 20% loss. However, what's much worse is that they can't keep paying and increasing the dividend, meaning that they'll eventually lose their dividend king status. This can cause a much lower ratio because the market won't react well to a dividend cut, meaning a significant crash. Again, they don't need some massive cuts, say 25% should even be enough in this scenario and they can even focus on repaying some debt, but why buy them then? In a better scenario, let's say they manage to grow thanks to the environment improving, which is tough to see in this market. Say they get to 10 billion in half a decade, meaning a growth rate of around 7%, which shouldn't be tough in a recovery. Put the ratio back to 30 and that's a 300 billion market cap, meaning a price of 218.82 and a 50% profit. Adding the dividends, that's maybe something like 70-80% in half a decade, assuming the increases. So if the economy recovers, this should be pretty good, and if not, they'll have some issues and maybe have to cut some capex or downsize, spin off or whatever to afford paying and increasing that dividend. By the way, if you want to support the channel and see when I buy anything or even get a custom stock analysis or even 2 each month, check out the Patreon link below. And now you also get all the other analyses ever requested by other members on top. So an interesting company overall. As the stock is falling, the dividend is slowly getting to 4–4.5%, which can be quite attractive for many portfolios and even for me. However, keep in mind that the payout has already reached the limit and if they don't manage to improve, it can become unsustainable and cutting it is probably game over for the stock. That's easily some 20% crash or even more if they cut enough, especially as technically a dividend king. But long term, I still think this can be a very nice slow and steady compounder. I honestly always like the company more than Coca-Cola because they are much more diversified. When the global and especially American economy improves again, this kind of company has potential to recover and get back to growth. As always, what I cover in my videos shouldn't be enough for you to make any investment decisions, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out and make sure to subscribe. Thank you for watching and I'll see you next time.